Hi, it's Lee, and welcome to the Tesla Economist. Alright, so Tesla's stock is down, but we seem to have lost all reference as to what its value is. The market loves financials and numbers, as they are the most tangible way of valuing a company, but all they have to go off lately is still this disastrous Q2, and then this Q3 deliveries result that had a large discrepancy from the vehicles produced. On top of all of that, we have Elon's actions which are affecting the stock price too. Therefore, there is not an accurate compass to use in trying to assign a valuation to this company. The market is lost right now. Then we can add all the other events that are occurring in the world that leave doubt to the future of the economy. Right now, we need some sort of ground to base Tesla's value on, and the most solid measurement we will have will be the Q3 earnings. I think this is an overly important quarter, as it will be very telling as to what is actually happening in the company as far as pricing is concerned. Although it is unfortunate that we were short over 20,000 deliveries compared to production. With people worried about Tesla's demand dropping, either due to Tesla's increased supply and reaching saturation in certain markets, or because the economy is turning and demand for high-end luxury cars is dropping. This Q3 is going to be the first quarter we will get to see all these price rises that have been happening in much larger effect. On top of that, in Q2, we had margins affected by lockdowns in Shanghai and the money furnaces of the new factories, so that we were not able to give us an accurate representation of Tesla's margins. If we see that Tesla's margins are really high, then sure, that'll be great for profit, but it will also give us an idea of how much buffer Tesla have for demand too, as in if demand actually does start to drop to a level where Tesla make more cars than they have customers, then how easy is it for Tesla to drop prices and still hit decent margins and match demand? Therefore, as I think margins are the most important element of this Q3, I'm going to go into a lot of effort in trying to calculate what these margins could be. I'm going to try and estimate what margins we've had previously, basing this on our Q1 margins. It's difficult to get an accurate cross-section of each model from each factory, but we will do our best. The way I plan on doing this is working out what the price of the vehicles were selling for back in Q1, and from there I will add on the additional price rises and calculate where this takes margins. Now, before you say inflation, think about it this way. If there had been inflation, it was more around the time of Q1, and what happened there? Tesla were delivering orders from earlier in 2021 due to the long waiting lists. Now, these orders were at lower prices, and now had to be fulfilled in that Q1, where costs would have risen due to inflation. Therefore, in Q1, Tesla were delivering vehicles with a lower price, yet higher potential costs. I don't think we should have seen too much inflation in costs since Q1 to Q3. In fact, a lot of commodity prices have dropped since. However, what we do have is higher price rises to compensate. In theory, that should mean that margins were actually affected by this increase in costs in Q1 even, and should have potentially been higher. Anyway, if we stick with what would have been similar costs in Q1 to Q3, then that might make for some accurate numbers. One of the other things that I think will surprise people is that the price rises are almost pure profit. In other words, although they do increase margins slightly, it's a higher margin on a higher priced vehicle. So perhaps margins only increase 2 or 3% with a 4 or 5% price rise, but actual profit per vehicle has increased about 15% more. That's what matters the most on financials, is the actual amount of profit that is increasing. Yes, margin increase means a lot too, from a business standpoint. I've never actually had a job and been in business my whole life, and I look at Tesla from the perspective of if it was my own business, would I be happy with how it is progressing, ignoring the market's opinion as much as possible, i.e. the stock price. For me, margins are very important. High margins mean not only is the product incredibly profitable, but also there is so much buffer there in case demand ever did drop. However, it's possible demand may even continue to rise, at least in some markets more than others. Let's take a look first at the last 2 quarters for comparison. I've broken them down into what we need. In Q1, Tesla was able to achieve 30% gross margin for their vehicles if we exclude regulatory credits, with an ASP of $52,000. Then, with all the issues we faced in Q2, like the lockdowns and new factory expenses, with minimal output, this dropped margins to just 26% without regulatory credits. Now that is quite a big drop, but is easily accounted for. It shows just how bad Q2 really was. And Q1 delivering 25% more vehicles in the previous quarter made it even more disastrous. It was a terrible quarter, but a lot of us saw it as a buying opportunity too, as we knew it was just temporary. However, if you ignore all that temporary negativity, you can find a diamond in the rough. Tesla's ASP rose from $52,000 in Q1 to $56,000 in Q2, a $3,800 increase, or 7.3% increase in price, as a lot more of these higher priced vehicles were being delivered this quarter. In my opinion, that's quite the price increase. So just a 7% increase in price means Tesla makes 25% more gross profit margin, or at least should have been if we hadn't been facing all these other issues. That would have meant 35% margins. That's absolutely massive, and that's still without regulatory credits. But this is just gross margin. We have to think about OPEX too. Tesla hit 19% operating margin in Q1, so that additional 5% in gross margin should all pretty much be carried into operating margin, taking it to 24% operating margin, which is a 26% increase in operating profit. And remember, that's solely due to the price rises. If deliveries were the same, we would have been seeing a 26% increase in operating profit. Bear in mind, in this scenario, it would also mean that the two new factories were not sucking out tons of cash either. However, they have positive gross margins now and are still in low quantities, so perhaps they don't take margins down too much. But we'll find out. And although China faced no lockdowns this quarter in Shanghai, they did face line upgrades, which meant the Model 3 and Model Y lines were both down for a couple of weeks. But that's just about 17% of the quarter, so possibly not too bad. But what did these line upgrades also mean? Reduced costs, as in even higher margin, or at least when ramped up. In other words, Tesla's Shanghai margins are going to increase even more. Also, Tesla are still ramping Fremont a little too, which also means better margins with more output. But as far as ramping is concerned, it's going to be the new factories that will have the most impact. Therefore, there is the possibility that margins may catch people by surprise this quarter, and if the overall margins are still diluted somewhat by Texas and Berlin, as long as they're breaking even, which they should be, then there should be all this additional profit from Shanghai and Fremont to come that was due to the price rises. I'd like to try and work out as accurately as possible as to what these new margins and ASPs might be for the quarter, as I think it would be good to get an idea anyway, but will also help us with an accurate earnings estimate. And although we will get the answer for profits very shortly, they won't be broken down into each factory or model, so this will still serve as a useful indicator on where Tesla are with their margins. In addition to waiting lists, I see high margins as the biggest buffer to any potential demand issues, which seems to be some of the main FUD circulating the future of Tesla right now. And this is mainly for the rear-wheel drive Model Y, which means as it is a lower priced vehicle, it has less elastic demand than what people are calling the luxury SUVs, and thus lowering the price further will have a much larger effect on increasing demand. And if the margins are potentially as high as 35%, then there is a huge buffer there with the ability to remain very profitable. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.